Hi everyone, myself Murugan. Happy to present another interesting video from EQSIS. In this video, I'll be explaining a concept $1 test. And this concept was proposed by a legendary investor, Warren Buffett, in the year 1984. By then, he was close to 50 years experienced person. The beauty of this concept is that a common man can easily understand and able to see whether the company is using the retained profit effectively or not. So towards this end of this video, we will be taking a top 50 Indian companies and see whether these companies are passing this test or not. So hope you will find it very useful and watch this video very carefully. Let me begin by explaining the concept well. See, when I buy shares, I expect return out of my investments. So the shareholder returns comes in two ways. One, with the capital appreciation, and the other one is the dividends we receive in the holding period. Let's say a person buying a share at rupees 500 in the year of 2015, and followed by that he is receiving a dividends. Let's say in 2016 he received 30 rupees dividend, 17 he received 40 rupees dividend, and 18 he received 30 rupees dividend, and 2019 the company has not given a dividend and something happened. So in total, the shareholder received a dividend of 275 as of today. So that's quite appealing dividends, am I right? Because on average, the dividend yield on a yearly basis comes around 7 to 8%. That looks so appealing. On top of it, the share price is currently trading at 650 rupees. So there is a capital appreciation of 150 rupees. So the total returns an investor made out of this is 275 plus 150, that's equal to 425 rupees. I hope this is not a rocket science for you to confuse with straightforward a simple concept. But the beauty is, this company looks very appealing because as an investor, in the matter of 8 years or close to 7 years, I got 85% returns. That 85 is because 425 out of my investment 500 rupees. That's quite appealing, am I right? I've got a positive returns. I got returns close to 12-13%, which is on average of equity market, above any of the fixed income products. I'm happy about it. But the point is, the company makes some X amount of money, but they don't pay all the money back to shareholders. They retain a portion. And what exactly they did with the retained profit is also my matter of concern as a shareholder. So that's what this $1 test comes into. This is the same snap of whatever we have seen some time back. But if I get in detail of it, look at this. In the year of 2060, the company made a profit per share is about 70 rupees, but the issued dividend is only 30 rupees. It means the company retained 40 rupees. So why the company retained this 40 rupees? Definitely for the betterment of the shareholders. So as a shareholder, I expect that any portion of profit is retained within the company should translate into the capital appreciation in my shares. Let's say if a company made 100 rupees profit and if they don't issue the profit, then I expect that the share price should increase by 100 rupees going forward, so that I see that if not, I've not received in form of cash, but at least it is translating in the share price. So likewise, the company retained 40 rupees in the first year, second year 40 rupees, third year 60 rupees. In 2019, they retained 70 rupees because they have not issued any dividend. In total, they've retained 310 rupees in last 7 years. But if you look at the capital appreciation in last 7 years, it is only 150 rupees. So the capital appreciation was not up to the mark. Although we all feel okay because the company provide dividend of 7% and the capital appreciation of 150 rupees, it looks good on the upfront. But the point is, the appreciation was not enough to that extent of retained income. The retained earnings was 310, but the capital appreciation is only 150. The $1 test says that anything retained should translate into a capital appreciation. And if it is more, it is very good. At least it should be $1 for every $1 of retained. This is what Warren Buffett said in his annual report in 1984. So this explains that the company retained and able to translate into the growth story of the company. Am I right? So if you want to perform this test, you cannot look at this for 1 or 2 years. It is good to have at least 10 to 15 years. In the base minimal case, you need at least 5 years. But even 5 years can be part of cycle. So it's better you have 10 years is what recommended from this perspective. Let me now show you with some actual example. In this particular example, I'm not revealing the name of the company. I will be revealing the name. First, understand what's happened in the company. If you look at the net profit in the year 2012, the company made a net profit after taxes 28,000 crores. Now, this data are actual and it is one of top 50 company in India. And in 1 year, they made a profit of 28,000 crore in the year of 2012. I hope by this, some of you might have judged the name of the company, but uh, just wait for a while, because the company made 28,000 crores, but they paid a dividend of only 7,000 crores. The next year, they made a profit of 24,000 crores. They paid. It means they retained 20,000 crores in the first year. Second year, they retained about 14,000 crores. So in total, they were able to retain 1,41,000 crores, because the cumulative profit they made is 2.31 lakh crores, and 89,000 crores they paid back to shareholders. The remaining 1.41 lakh crore is retained within the company. But if you look at the market cap, this company was 2.3 lakh crore company, has now become 1.55 lakh crore company. Although the company retained 1.41 lakh crore, but the company share price got declined. What does it tells us? The company policy of retaining the shareholders money is not effective. Company were not able to effectively utilizing it. Something going wrong in this company, because the company were not able to utilize it for the growth of the shareholders. Am I right? Rather, if you would have given this back to shareholders, the shareholder by this time would have got at least additional 141 crore in the form of dividend. So this company may get a recommendation to pay dividends, or better not be very aggressive in reinvesting. This may be a high capital intensive company. The company name is ONGC. So ONGC is not able to grow to that extent of money retained, is what the conclusion it says. So let's look at the next company, and it is also an interesting company, but I don't want to reveal the name of the company upfront. The March 2012, they made a profit of 989 crores. Okay, it was under 1,000 crores, just 989 crores, out of which they paid a dividend of 383. They retained 600 crores. Okay, and if you look at last 10 years, the total profit happens to be 20,000 crores. Only 20,000 crores the company made a profit, out of which they retained 10,000 crores. They retained. So the dividend paid is 10,000 crores and they retained 10,400 crores. There are 50% retention is there in this particular company, close to 50% retention in last 10 years. But if you look at the market cap in last 10 years, it was a 31,000 crore company, now has become 2.78 lakh crore company. It means the company retained 10,000 crores, but that is justified with the market cap growth by close to 2.4 lakh crore. That is nothing but 23x growth of its retained incomes. So this company retaining my money is not a problem. So I definitely say this, the company is retaining the shareholders fund for the betterment of the shareholder, and it is getting visible in the share prices as well. So this company retention policy will not be questioned, and this company name is Asian Paint. Okay, so now the point is, are we get so even if you look at ONGC, Coal India, a lot of other companies, we are getting a lot of yield, okay, dividend yield. But the point is, on top of it, the company has some retention. Is these retentions are effectively utilized or not? So now what is important? We are now concerned about last 10 years retention along with differences in market cap. These two factors is what we need to see whether which company. So on by just comparing this two factor, Among top 50 company, we can easily understand that the companies which are qualifying or not. That's what I'm going to display now. If you look at this particular Excel sheet, okay, what it actually gives you is in first column, it gives you the name of top companies, top 50 companies by market cap as of July 2014. And if you look at Adani Ports, the market cap is 1.54 lakh crore, but it was 70,000 crores 5 years before. And last 5 years profit in Adani Ports is 21,000 crores. But in last 5 years, they paid a dividend of 3,000 crores. So the point is they retained 18,000 crores. They retained 18,000 crores, which is 85%, 85% of the profits are retained. 85% of the profits are actually retained. So this is what it says. 85% of the companies are retained. But the market cap were able to grow by 84,000 crores. So basically for every $1 it retained, it were able to grow by 4.5 times. This is what in this particular column we were able to see. So it's very clear that Adani Port, although it retained 18,000 crores, it were able to grow by 84,000 crores. So this is the comparison, am I right? So now what we're gonna do is Asian Paint were able to, in last 5 years, they retained close to 6,500 crores and they gained the market cap of 1.7 lakh crore, which is effective. Avenue Supermart have retained the whole profit. Whatever profit made by the company is retained, but they're able to gain the market cap. They were able to gain the market cap by, so 100% of the profits are retained by Avenue Supermart, DMart, but interestingly, they were able to expand it well. So their retentions are not questioned. So what I'm going to do is, we are now going to sort this company. We are going to sort this company based on this $1 test. And then we'll get to know that a company like IOCL, Coal India, Hindustan Zinc, ONGC, these companies' market caps are actually got lower. These company market caps are lower. Okay. So, but they are also retaining. Look at the company, 35,000 crores you retained, but the share price went down. It means although you retained, you were not able to translate into the growth of the company. Rather, you burned the shareholders' wealth. So, better you would have given this 35,000 crores to the shareholders. They would have been happy with that. So, in Coal India, they retained 25,000 crores, but their market cap was not witnessed it. So, this is the concept as such by the Warren Buffett. And if you look at Hindustan Zinc, their retention is very low. Their Hindustan Zinc retention is very low, but still they were not able to grow much. And if you look at the company like ONGC, they are retaining 68% of the profits. 68% of the profits are retained. In spite of that, they were not able to grow. In fact, they are showing a degrowth. So these companies' retentions are not great. So this is not a really great companies we are getting it. But no doubt, Coal India looks like a fantastic company on the dividend yield perspective as well. I don't mind. And the company has a lot of front, it looks good. But for some reason, the retained earnings were not able to be translated in the growth. And if I get in towards the end, we'll look at the downside companies. If you look at Nestle, it's very interesting because the Nestle made a total profit of 9,200 crores in last 5 years, out of which they paid a dividend of 9,000 crores. Except 100 crores, I can say it's close to 100%. Whatever profit made by Nestle are given back to the shareholders. So the company doesn't seems to be requiring shareholders fund anymore. They are not at all interested in keeping the shareholders fund in the company. They are actually paying back whatever they make in the given year. In spite of that, the share prices gained. The market, they were able to gain 1.16 lakh crore market cap. So look at this, they retained almost nothing, but they're still able to grow. So this is a classic example of a very good company. I can say it's a great company because this company doesn't need money of last year's profit. In spite of that, they were able to grow. Look at this company, Avenue Supermart. They retained the whole profits, but in spite of that, they were able to grow. So this is also a good company because this company justifies the intention of retention. So if the company is at a growing stage, if the company is at the growing stage, and if a company retains and it should grow multiplied, impact, that makes the shareholders happy. So if you look at this, interestingly, Nestle, Britannia, Bharat Airtel, Hindustan Unilever, DLF, Avenue Supermart, Titan, Asian Paints, Pidilite, Havells, Siemens. Interestingly, in this particular test itself, we are getting all good companies coming in front of us. So you decide, or on these grounds, what is your view about it? What company you have seen? What other companies? Because we have taken only top 50 company, but if you come across any other company, okay, do put it in the comments. If you look at this video and just watch, and if you feel great by learning this concept, it may not be productive. So as an exercise, what you guys can attempt is, you guys can go to screener. If you wish to take a Bharat Forge, which was not a part of 50 company which we evaluated, and if you scroll down and if you see what are the total profits they made, the total profits they made, you can actually sum this, okay, and make sure that you take about only 10 years, okay, and then you go and check out the market cap, and by looking at the market cap, whether the company were able to grow the market cap or not, and put your response in the comment section, so that you learned something and you were able to apply this. And the concept is very simple. If a company made a profit, and that profit should belongs to the shareholders, so for any reason, if the company retains the profits, that profit should translate in the share price. And if it is not getting translated, then it shows that the company is not effectively utilizing that money. That's a reason why the next shareholders are not willing to pay more and buy that particular thing. So this was the $1 test, and it was proposed close to 40 years before by Warren Buffett in the year 1984, as of this. So it's good to know, and a very great concept to learn. And if it is helping you to find a good stock to add in your portfolio, we are also happy about it. By any chance, if you want this particular Excel sheet, and this Excel sheet consists of two things. One is the summary of top 50 company, and you can easily sort it down to see whether which companies are actually qualifying this particular $1 test, because out of which you get to know that IOCL, Coal India, Hindustan Zinc, and this is as of 2022 July. And the company which are extremely doing well are the companies like Nestle, Britannia, Bharat Airtel, Hindustan Zinc, DLF, Avenue Supermart, these companies. So if you want this particular Excel data so that it helps you in your research, what you guys can actually do is you can ask us, you can ask EQSIS. So you can find this link in our website, which is go to EQSIS.com, and if you scroll down, you will find this section called Ask EQSIS here. And if you click Ask EQSIS, it will be showing you this. So there you have ask a question, and then you type in here that you need a $1 Excel sheet or something. And then when you mention this, it will ask your name and an email address, and that particular email address we will be sending this Excel sheet as well. And we are not charging for this Excel sheet. It is totally available. Just we believe that it can enhance your research and makes it much faster. So make use of it if you really wanted it. And that Excel sheet consists of two things. One is that summary of top 50 company. The other one is the top 3 company. We have an example. One is Coal India. We have given this example, and Asian Paints and Nestle. And of course, the source of this particular data is available in the screener.in. And from there, we have actually taken all of this data. So we don't actually authenticate any of the data points, but I think this is fairly reliable is what we believe when we are using it. So hope you will enjoy this the whole video. Thank you.